Why cash is a guaranteed loss. Investment wisdom. Understanding risks and growth in investment choices. Understanding the guaranteed loss of cash. Impact of inflation on cash. Cash and purchasing power. Cash loses value over time as inflation erodes its purchasing power, making savings less effective. Negative real returns. When inflation exceeds interest rates, savings yield a negative real return, reducing wealth. Long-term financial impact. Over the decades, inflation can drastically reduce cash value, harming financial security and retirement plans. Psychological biases leading to poor decisions. Deprival superreaction tendency. This bias causes people to fear losses more than they value gains, leading to acceptance of guaranteed losses to avoid risk. Social proof tendency. Keeping money in the bank is common, creating a false sense of security reinforced by social conformity. Availability misweighing. People fear vivid events like market crashes while ignoring gradual, unseen inflation effects, harming purchasing power. Strategies to avoid guaranteed loss. Productive assets and their advantages. Business pricing power. Businesses with pricing power can raise prices to match inflation, ensuring steady earnings growth and value compounding over time. Stock market returns. Stocks have historically delivered about 10% annual returns, outperforming near zero real returns from cash investments. Real estate inflation hedge. Real estate adapts to inflation as rents increase, mortgages are paid with cheaper dollars, and property values rise with construction costs. Investing in skills. Acquiring valuable personal skills enhances earning potential and offers resilience against economic fluctuations beyond traditional investments. Additional asset classes and practical guidelines. Emergency fund importance. Maintain an emergency fund covering 3 to 6 months of expenses to ensure liquidity for unforeseen needs and reduce cash holding losses. Value of hard assets. Hard assets like productive land, machinery, and tools generate income and functional value, unlike non-productive gold. Role of short-term bonds. High-quality short-term bonds provide liquidity and optionality, while aiming to yield above inflation to avoid losses. Long-term impact and action framework. Mathematical comparison and consequences. Cash growth versus purchasing power. Cash grows slowly nominally, but loses significant purchasing power over 30 years due to inflation. Investment growth potential. Investing in the stock market yields substantial nominal and real purchasing power gains over the long term. Financial impact on retirement. The choice between holding cash or investing greatly affects retirement comfort and financial stability. Actionable steps for financial success. Financial framework essentials. Identify your expertise. Understand true risk as purchasing power loss, and clarify your investment time horizon. Cash versus investment allocation. Keep money needed within 6 months in cash. Invest long-term funds to avoid guaranteed losses. Avoiding poor financial outcomes. Consider second-order consequences and avoid excessive cash holdings that reduce life options and retirement quality. Key success formula. Spend less than you earn, invest wisely, be patient, and avoid irrational financial decisions.